Three stocks now account for 20% of the S&P 500's value. With this high concentration hitting extremes, some investors are nervous. For the first time dating back to the year 2000, three U.S. stocks, Microsoft, Nvidia, and Apple, account for more than 20% of the value of the S&P 500, according to Dow Jones market data. The top 10 stocks in the S&P 500 now make up a record high 35% of that index. As high as the concentration is for the S&P 500, it's even higher in the tech-heavy NASDAQ 100. As of June 5th, market close, Microsoft, Nvidia, and Apple comprised 41% of the NASDAQ 100's value. Wow, three stocks as an index comprising almost half of that index's performance and market cap is almost unthinkable. Is it possible that the strength in Nvidia and other mega caps has masked a weakness in other areas of the market? Katie Stockton, founder of Fairlead Strategies, thinks it's possible. In a report that she shared with MarketWatch, Stockton stated that small caps, mid caps, and the Dow Jones Industrial Average, along with equal-weighted versions of the S&P 500, are all showing signs of deterioration. The divergence in relative price between the equal-weighted S&P 500 and its cap-weighted peer has grown more extreme, with the equal weight index underperforming again this year. The ratio between the two recently touched its lowest level since 2009, according to the Bank of America Global Research. The last time so few stocks outperformed the index for 2 years in a row was in 1998 and 1999, right around the peak of the dot-com bubble. But this high concentration doesn't necessarily mean that we're headed for a 2000-like market crash. Investors would be hard-pressed to argue that the current market environment is similar to the dot-com era. The dominance of the largest stocks today largely reflects earnings and sales growth that dwarfs what other companies have seen. This is vastly different from 2000 tech bubble, which was characterized by very high stock prices for many companies that were piling up huge losses. And there's some historical data showing that rising concentration can coincide with stronger returns. As you can see from this chart provided by Counterpoint Global and Morgan Stanley, which looks at data from 1950 to 2023, it appears that the S&P 500 has actually performed better during periods of rising concentration. But is it possible that we've already seen the benefits over the past 18 months? With increasing concentration and large gains in the S&P 500 that we've already seen. The fact that so few stocks have contributed so much to the indexes has become a frequent complaint expressed by bull market skeptics. Many believe that if the rally were to fizzle out, it would be because stocks like Nvidia, which have driven an outside percentage of the S&P's gains since early 2023, suddenly stop climbing. This chart, provided by Richard Bernstein Advisors, illustrates how the percentage of S&P 500 stocks beating the index has remained unusually low in 2024 at about 30% according to FactSet data. The S&P 500 is up almost 12% as of June 7th. The market is, of course, forward-looking, and skeptics question how much longer companies like Nvidia can keep up their breakneck pace of growth. After all, semiconductor companies have proven to be extremely cyclical in the past. As always, we're keeping our eye on the market and positioning our portfolios to balance risk and return. Thank you for the trust and confidence that you've placed in me and my team. Feel free to give the office a call to talk to your advisor if you have any questions about your investments.